Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup-Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Cem Karsan and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Cem, it is really great to be back with you this week. Very excited for our conversation. I'm thinking it's going to be a little bit more free-flowing than what we normally do. But first of all, how have you been?
Doing well. It's summer in Chicago, so always nice. Kids are away at camp. So also have some time. Haven't had much time like this in a long time. So my son's off to school soon. That's kind of what's next.
It's a big change, yeah. Are you also having some time off before the autumn starts?
Yeah, not really any vacation. But again, Chicago in the summer, no kids is kind of like a vacation for me. So.
I know what you mean.
Yeah.
Now, we, as I said, in terms of the topics, we'll see where we go on that today. I'm sure it's going to be a great lineup, as I always say, but I'm not entirely sure what the lineup is going to be. But that only makes it more fun, I think. Anyways, what I do want to know, as always, is a little bit about what's been on your radar, what you've been thinking of, not necessarily to do with the markets or whatever, but just something that you find interesting at the moment to keep an eye on?
Yeah, I think the growth and scale of both hedge fund investing, right? The investment size in hedge funds has grown dramatically, as well as the structured product, and those two things are starting to interact. So that's kind of where my head's at a lot. I'm thinking a lot about how positioning is dramatically different than we've seen in the past, and what that's doing.
Okay.
Yeah.
Well, I'm sure we'll dig into to that. On my side, a couple of things that I thought was interesting, and this is, of course, besides the all-important Tour de France that I'm following at the moment, because we have still a Danish rider who could win it.
Nice.
I hope. But besides that, something I thought was very relevant. I've actually mentioned it on the podcast the last week or so, and that is just. Because you correctly called, and we're not going into right now the future of what you think is going to happen, but what I thought was interesting about the last call you had, where you did expect weakness coming into the second quarter, what we've then subsequently learned actually is that the recovery has been the quickest that we've ever seen. I think 57 days from a 20% drawdown or more, and it's without the Fed doing anything. And I thought that's very interesting. And I was just wondering specifically now in hindsight, whether there was anything from your world kind of below the surface that we don't see usually, that was kind of indicating that it could be such an unusually quick recovery in the equity markets.
Yeah. So on the next You Got options that we were going to record, we will be meeting with the CBOE quantitative team and getting some deep insights in data that they've been looking at. One of the things that I'll tease is in that last drop, the explosion of the VIX actually came from a very a place you really wouldn't necessarily suspect, which was massive call buying into that decline. And in the S&P 500 specifically, that led to a dramatic increase in vol. It was not from the put side. It was not a skew event, which is very different than what we experienced last August. So both had similar vol reactions, but from very, very different parts of the curve. And so the VIX levels look similar, but again, if you look at attribution and where it's coming from and what drove it, very different. So there was a call squeeze that came once it got started for sure. And a lot of that was driven by some big buyers in the S&P 500 into that decline.
Well, I can't wait to hear that one, of course. And I think we'll be publishing that in 3 or 4 weeks. We obviously this week published your latest conversation with a true legend from the markets, Rick Santelli, you and him on the CBOE floor.
Yeah, that was fun.
Very interesting and fun conversation. I really hope people will go and check that out if they haven't already. Couple of other things that I noticed this week, maybe even this morning, that I thought was interesting because we don't really talk about it as such. There's been a lot of talk, of course, about how trade relations and interactions with the US is under pressure and probably diminishing at the moment. And then I see this headline that actually China's Belt and Road investments and construction activity is hitting record highs this year, which I didn't expect necessarily, that whilst we in the West potentially are kind of, doing a little bit less with other countries, so to speak. But over here, they are just powering away and setting new records. And it kind of shows the difference in maybe the mindset and maybe the long-term planning that they're doing. I thought it was interesting. I'm not sure I have a question there. Maybe you have a thought about this.
Yeah, I mean, I think the obvious comment here is, and I think this is, if you try and bully people around and push them in a corner, they're going to look for alternatives. And I think it shouldn't be a surprise, right? And China is taking the long view, and this represents an opportunity for them to look like the stable, kind of mature government in the room. I never thought I'd be here telling you, China's more free market than the U.S., right? But that is the approach they're taking, and it's a very strategic, important kind of approach for them, particularly when it comes to resources, right?
Yes.
I mean, that's a big focus that you and I have had in a lot of our conversations. That's going to continue to become a bigger and bigger part of the conversation. I had a lot of conversations last night about kind of energy and where it's going. I'm sure we'll cover some of that today.
Okay, yeah, no, look forward to that. Actually, interestingly enough, you mentioned materials. Of course, I'm sure most of the people listening today is aware of that the U.S. Department of Defense has taken a stake in a rare earth mineral company recently. But I saw a headline today, which may not be new, but also Apple now put in $500 million in a rare earth mineral company in the U.S. Interesting. It's almost like, a few months ago, they were all starting to build up their own nuclear power supply of energy. Now they're buying into rare earth minerals. Not what you would expect from a tech company a few years ago, that's for sure.
Well, I think it's going to be interesting. Again, we've talked about this here, but it's coming to fruition. Who the benefits of AI accrue to have not been made clear yet. And we have been talking about for some time that it's likely to actually to go to resources, the amount of power needed to do this, the amount of resources needed to generate, this massive advancement that we're seeing is dramatic, and we're seeing that every day. And I think there's several other places that maybe are not intuitive, but yeah, I think that's going to continue to be, especially given the pace of AI growth that we're seeing.
Yeah. So I've mentioned two things that I felt was a little bit under the radar. I have one more thing that is a little bit under the radar. I'd love to hear your thoughts on this. We have talked over the years about, systemic risk and the risk to the system. And of course, in your world, this is something that, you can certainly see maybe much better than in other types of investments, because it deals with fear and uncertainty and risks and hedging and all of that stuff. And then I was reading, this is from the latest earnings call from Goldman Sachs. And I think I'm quoting now a Bloomberg or some kind of news headline about it. And it says that on the earnings call, the CEO of Goldman Sachs, I think it was, basically said that it is now among the top three brokers of 125 of the world's 150 biggest stock trading clients. And I'm thinking, wow, that's a big concentration risk. I mean, 5-6 years ago, they were down as, maybe they had half of that in maybe a little bit more, say 80 relationships like that. But I feel that that's another risk one could see play out in a crisis if all of the big stock trading firms are doing business with the same few firms.
Yeah, definitely the volume is becoming very concentrated. And it's honestly true. I mean, you can relate it to all industry right now. If you think about where we are, big companies are getting bigger. Happens in technology, like the Mag 7, right? We have just these massive businesses now, and it's happening in finance as well. Yes, there are benefits to those firms, and this is true in all things, right? Absolute power corrupts absolutely. You're big enough, you're more powerful, you can bully up, but there are costs to that. Fragility is definitely one of them. We do not have the ability if something goes wrong to kind of pivot as much. I think that's a very true for us writ large and where we are going. It will not take much for the sand pile to kind of collapse once it does.
Sure. Absolutely. All right. Okay. Let's do a quick trend following update. July is off to a very, very quiet month. Actually, it's unusually quiet, I feel, when I look at sort of daily returns from our industry. I don't know about how do you feel about July so far, but so far in our industry, it's been super quiet, very little movement every day. It's pretty flat at the moment still for the month. Of course, that is better than what we saw in Q2, where every day was like a challenge almost. But anyways, there has been a few opportunities, such as still metals on the long side, especially copper, as we may touch on if we talk about tariffs during our conversation. Equity still moving along nice and quietly, but to the upside. And of course, the other interesting theme, which I'm sure we will touch on later on, is the kind of short exposure to US fixed income markets, unlike European fixed income markets, which have been more exposed to the long side among CTAs for sure. Maybe with the exception lately of the Italian bonds that have been on some more pressure, I would say. Also, there's been a little bit of profits to be had in currencies. However, the British pound, which has been a decent performer in the last few months, is under a bit of pressure this month in July. So that's very where we are right now. My own trend barometer actually reflects this perfectly. It stands at 45, which is completely neutral. So neither bullish or bearish for that matter. In terms of performance, as of Tuesday evening, we're recording on Thursday, beta 50 down only 13 basis points in July, down 3.38% this year. SocGen CTA index flat, up 2 basis points, down 7.59% this year. SocGen trend down 21 basis points, down 10.18 this year. And the SocGen short-term traders index doing a little bit better, up 72 basis points, but still down 4.61% so far this year. In the traditional world, MSCI World is up 30 basis points so far in July and up 10.10 for the year. The S&P aggregate bond index down 81 basis points for the month, up 3% for the year. And the S&P 500 total return up another percent in July and up 7.25% so far this year. Now, Jim, we had two questions come in, but the second one really is about sort of your outlook, comments to what's happened so far. So I'm going to keep that to the end, where we're going to go into that segment, which I know people love to hear your thoughts about. But before that, a question came in from Rick. Rick says, Jim had an incredibly call, probably 12 to 18 months ago, on buying gold calls. I believe he was simply looking for a low implied volatility at the time, and a $3,000 call seemed ridiculously at the time, which is probably why it worked. What other asset classes, vols, are mispriced at the moment, and is positioning ever on his radar when considering trade setups? If so, how do you specifically look at this data?
Yeah, so it was about 2.5 years ago when gold was really out of favor, which is hard to even imagine now, right? And it didn't make sense at all. And by the way, at the time, oil, you'll remember, was flying.
Yeah.
And the call was not just, hey, look, historically, if you go into these populist periods, 60s, 70s, we talked about, right? These periods where you get inflation and it's structural. Gold is going to be the best performing asset, and it makes no sense where it was. But the other part of that call was that that vol historically during those periods is gold was the most volatile asset during that time as well. So the call was, hey, go buy really long dated calls. This is going to be a win-win in both directions. And sure enough, it wasn't just a big rally, but it was, the vol has dramatically increased as well. And the opposite is true for oil. To kind of build on that, we said go sell puts in oil. Both assets tend to be very bullish in these periods, but very different in how they are bullish. And that is something maybe people don't think enough about. Oil tends to perform well, but very consistently well, and has a floor to it during these periods because of geopolitical conflict, which we have seen plenty of since then, which has driven a floor. That was our big kind of comment. And you're likely to continue to see this kind of floor. Now, trade comes down during protectionist times, so that also, makes it such that it doesn't rally too fast. There's kind of a push-pull, but there is a consistent trend to oil that does very well during, over the long run in these periods. And so, we sold puts in oil. We bought calls in gold, and both have been incredible winners over that period. Going forward, still love those plays. Obviously, they're not nearly as much of a home run. I do still like selling puts in oil. That's something to continue to do. Historically, during these periods, and we talk big picture.
Yeah.
When we were talking about this, and this is not just a 1 week, 1 month call, right? These are no pun intended. These are long-term calls. That's why, we bought long-dated calls. But the things that work best, the volatility that works best, is actually not equity vol, which is the first thing that people think about. People think, the markets are going to be shaky, or they're not going to perform well. We need to buy equity vol. The reality is, during these periods, through inflation, you kind of get a decline in real terms, but in nominal terms, equity markets end up going not much of anywhere over the long run. And you can get a lot of down, up in the meantime, and there'll be a lot of geopolitical conflict, but net, you can find yourself going not much of anywhere. And if you go back, now to 2021, at the peak in 2021, we're only up 25% or so in 4 years, right? Or 3.5 years. And at the lows, by the way, just in April, we were unchanged. And so this is what I think this decade looks like. And by the way, 3.5 years, we've been talking about this, or so, like 3 years we've been talking about it. And everybody thinks all these things have happened, but really, what has happened? They haven't really gone anywhere. And I think equity vol is, particularly indexes, I would avoid as your hedge instrument if you can. If you are going to be in equities, it's about rotation. It's about dispersion. You are going to see under the hood dramatic rotations coming in. I think one that we haven't seen yet is growth versus value. And I think that's one that I think really, really eventually is going to hit here. So if you're going to play something with options that has a incredible opportunity for a big payout, it would be that cross factor play. We are actually seeing a very interesting, and we'll get to this a little bit later, this summer, momentum versus value breakdown, and that's significant. We saw this last summer. It's being driven by some of the same factors. I don't think this is the beginning of a massive move yet, but I do think that part of the market is very, very interesting to me right now. And by the way, a couple of big players, Druckenmiller being one of them, has made a ton of money on Russell calls versus at 2 times now, speculating that he's doing it again here because there's been a big buyer of calls in the Russell relative to other places in the market. So that is a very interesting area in the equity market. If we start talking about other things, commodities and other areas, I think you're going to see something in uranium that is going to be wild. We've seen a bit of the plays on it happen, but it is any place where you have a rare, concentrated good. I think that's going to become a convex outcome at some point. We talk about rare earths. That's something, by the way, you and I have talked about for years, but it's not a novel idea. But there are other things that are very concentrated. Uranium is one of them. Most of the uranium in the world comes from just a couple countries, Kazakhstan being the biggest, Canada being the other. And Kazakhstan is not exactly in a very kind of stable neighborhood. So that is something to think about. I mean, there are other assets like that, right? And copper actually is also
biggest one-day move since 1968, only a couple of weeks ago.
And copper production is very concentrated in Chile, a couple other places. Remember, the OPEC crisis happened because OPEC is able to control, at the time, not as much anymore, completely control the price of oil. When you get into geopolitical conflict, at some point, somebody's going to want to flex their muscle, and strategic, if it's easy to do that because it's concentrated. This is, again, we talked about concentration just as it relates to financial companies, similar idea. If it's a asset that is concentrated in one place, it becomes unstable. And in a time of geopolitical conflict, more likely to become an issue at some point. So those, and the more strategic it is, the more critical it is to everybody, the bigger the deal. So I would be thinking about those things a bit. And then lastly, the thing that will continue to perform for the next decade in terms of vol is FX. FX is going to be the best play in vol for the decade. You will see dramatic, and that's why part of why gold's performed as well. Gold is a not really a commodity. It's a currency, and that's part of the thesis of why you want to own the FX and currency vol, and not really the commodity vol. Doesn't mean you're not bullish on both, but different play. And FX will continue to be an incredible opportunity.
Before I let you go on this topic, what about bond vol? It's a massive area of anyone's investment portfolio. Any thoughts on
absolutely, that? Yeah. Bond vol is also a dramatic buy. I would say after FX, that's probably the next best area to be in.
And how far out? I mean, just not that we are giving any investment advice specifically here, but 2 things springs to mind. One is, how far out should you even consider buying this vol? And in terms of timing, do you care at all about that? Or is it just something where you say, I have no idea if it's now or 6 months from now, but I have enough duration on my investment that it's not going to be too sensitive to the timing?
I don't think there's any reason to do anything less than a year, because this could take several years. I think you should. I'll put it this way: the next 3.5 years till the election are going to be a crazy time for bonds. Just look at what happened yesterday with kind of the Powell commentary. If you don't see the similarities between Nixon and Arthur Burns, I can't help you, right? And I think we know what happened then. So there are going to be dramatic moves. I think we're also inevitably heading, as we've said now for years, towards a debt jubilee, and I think that's sometime in the next 5 to 10 years. And so that's going to mean volatility in the bond market. And it's going to mean cross country volatility, and currencies as well. You see what's going on in Japan. We've talked about that for a while. We already saw last August, and we had talked about that. It's a massive, yen dollar carry trade blow up. this is not a one and done. This is not something that is just, and by the way, we've called the steepener from 3.5 years ago that we've seen that's been dramatic. This is just the beginning.
You know what? I'm already looking forward to our next conversation with our friend Dave Dredge on this, because you and him on vol is very insightful, to say the least. So
he's the FX master, right? I love talking to him for that exact reason as well. Yeah.
All right. Okay. So let's move into something a little bit of free flowing here in terms of, I'm going to let you kind of talk about things that you wanted to express. I might jump in with a few topics, but normally you like to talk a little bit of macro initially, kind of yield, inflation kind of stuff. What are you thinking at the moment?
Yeah, a couple of big things come to mind. One, the placidity of the markets, right? The summer of George, which we'll get into on the prediction side, like the crumbs at the end. But I do think there is a historic amount of vol compression happening, which is tied to these massive inflows, as we've talked about before, from into structured products and structured product-like instruments that are vol compressing. In the summer, volume goes down. People are at the beach. People are, not trading. And that paired with hedge fund, as I alluded to at the beginning of the conversation, positioning, which has also doubled in about 4 years, is creating massive behemoth size positioning that the market is not used to, and it's changing dynamics. Those two things are starting to interact. So in a summer where there's no volume and positioning is, gross leverage and long short equity at hedge funds is usually 3x, sometimes bigger. It's by far the biggest, it's about 50% of hedge fund assets go into long short equity, or 40 to 50%. And we've doubled. So, and with all the gross leverage in there, and they're all coming from the same pods that then go off and start their own. And so there's also a kind of a similar set of, bearer factor models that everybody uses. And at the end of the day, we're also all human and we use logic. And so everybody, despite trying to not get stuck in the same trades that everybody is, and people creating factors on positioning, they have the same positioning. And in a no low volume environment, not to mention with a vol compression. Now how do these two things connect? This is the big aha. If you have massive vol compression, no volume, and you have long short equity positioning that's gross, that's massive, what happens from the vol markets when we have massive vol compression? Dispersion, right? Because the compression is happening at the index level, right? And so that index level compression is leading to everything moving away from each other, a pressure that forces everything away from each other. And at the end of the day, if that's happening, what do you think's moving up and what do you think's moving down? It's a pain trade, right? And the summer George has become a very painful trade in the hedge fund space.
Yeah.
And so that's one of the biggest things we're kind of watching and thinking about. Hedge funds are under a lot of pressure and pain. Last summer, this exact same thing happened. That's why you're starting to see this momentum value roll over, which we saw last summer, that led right into expiration last year in July. And of expiration, we started a decline that kind of filled those jaws, right? Momentum value versus value often leads the market lower. It's a leading indicator, very good one, that people who, by the way, may not watch these things as closely should always have up and be looking at. But last year, those jaws opened, and then at expiration, they started, the market started to follow momentum value lower. That was a function of hedge fund pain last summer. The difference is hedge funds weren't really short last summer. Hedge funds were actually equal weight, if not more. Now they're short, and the pain trade is getting hit, right on the long short equity side. That's what that momentum value turn is. And by the way, this is what I think Druckenmiller and others are seeing when they go buy that value call. It's a positioning play. And so they're squeezing it, and and retail is squeezing it, and piling on, and the shorts are making it even more painful. So this is again a summer of pain in hedge fund land right now, and that can end badly. Part of what happened last summer is that hedge fund pain eventually led to a degrossing that once the yen-dollar carry trade kicked in, kind of exacerbated the move. Again, I don't think a vol that's coming this time,
Right.
because it happened last summer, and we can get into all those dynamics predictions going forward. But point is, that's the big thing that I'm really watching and looking at. The positioning in the market is massive, and both of those dynamics, and eventually that'll go the other way. But for now, as long as volume's low and vol is well supplied, this is a deleveraging, degrossing event that's happening in a very illiquid market.
Can ordinary investors follow this easily and kind of have an idea when something like that might get triggered? I mean, what would be kind of a telltale saying, well, now the game is starting, so to speak?
Yeah, there's no explicit hedge fund pain. I think momentum value is a good kind of extreme.
Okay.
I would watch that. The other thing is, as we've talked about, these calendar dynamics are even more important. If you go look at the last 2 years and look at kind of expirations, I mean, we've talked about it for years. It's always been good, but it's getting to a point where every expiration is a turning point. You can literally, I encourage listeners to go just bring up a chart of the S&P 500 for the last 2 years and just draw the expiration dates and just look. And they are massive inflection points because the options volumes are becoming dramatic during those periods. And so the relief, and here it is. By the way, we're recording this on expiration, Thursday. That Friday, tomorrow morning is expiration. And so
is July an important one for you?
Not nearly as important as let's say a August or a September or a May or June or a Feb or March. The one leading into
quarter end.
Quarter end is the biggest. But as we saw last summer, sometimes they get started early and then the continuation happens. And again, we'll talk a little bit more about kind of what we see happening as it relates to that. But so it is important, but not nearly as important as next one.
Sure.
So we'll be watching that closely.
Cool. Okay, cool.
From a macro perspective, the biggest thing right now is, the economic numbers from the tariffs are just starting to come through. And this is earnings season. And the way I think about kind of how we begin to see this is actually starts with earnings. If you think about inflation, tariffs, a tariff is a tax, obviously, and that tax gets borne by who? First corporations, eventually people, but first corporations. And corporations then have to decide, okay, am I going to pass this on or am I not going to pass this on? And depending on what they decide, depending on what they can do, they either hit the profit margins, right? Or they don't. And at first, it's usually a profit margin hit right away. And then they say, okay, can I increase the cost out? So I think we're going to see that this time. This earnings cycle is very important for that part. We haven't seen a massive increase of inflation yet, although numbers under the hood are definitely increasing. And there's a lot of kind of the numbers from the government are not really showing that. And that's true for employment as well. We can kind of talk about that a little bit at some point here. But the reality is, what cannot be hidden is in quarterly reports, CEOs have to talk about their earnings. They have to be forthright with what's happening there. And so those numbers are not going to lie. And I'm really, really watching these big earnings coming
And
through
it's
this
still
time.
a quarter with pretty soft tariffs, right? Because a lot of it was rolled back. So we haven't even seen the worst to come. And certainly with the noises that the administration is making in terms of where they may land,
Yeah. Guidance is really what's going to be important here. The first guidance, the last time they cut guidance, weren't sure how this is going to play out. It was very kind of new. There's going to have to be more guidance coming there. I think that's really important. First step, I think, would be to see margin compression, and then would come, inflation kind of numbers to start ticking up. And I think we're starting to see that under the hood, but I think that'll be more clear after, and really that's a month or two from now. And then comes the employment number, because if you start getting less profits and more inflation, that becomes a cost on people ultimately. And I think the employment thing is very, very interesting, particularly given what's happening with AI at the same time. There's a confluence of AI effects, and we really haven't talked about that on here, which we should probably start talking a lot more about, which is how AI is kind of interacting with the kind of tariff and protectionism and all the populist stuff that we've been talking about, and that those two, the confluence of effects. That is a bitch's brew of potential problems, particularly because it's concentrated on the young, on the college graduates. And that is where the populism is coming from, is the younger kind of cohort. So I think there is a very, very interesting dynamic developing there.
Yeah, for sure. Actually, I'll probably want to touch on this a little bit later in our conversation today, given something I listened to this morning, actually, although it's about a week old, but it's really important. So anyways, before we leave completely the whole inflation, you kind of alluded to it, and I do think it's important for people maybe to be aware of this. On one side, you could say, yeah, CPI came in a little bit hotter, and obviously that justifies the Fed stance. Then PPI came in, I think, actually better than expected. What people should know, a couple of things, actually, and that is CPI includes imports. PPI it does not include imports. So very important when we talk about numbers at the moment, given what's happening on tariffs. And the other thing, something that you and I spoke briefly about, but I was simply not aware of this, but I got this morning an email update from the good folks over at Odd Lots, and I love their topics that they bring up. And one thing they alluded me to, or they wrote about today, was how the numbers that the government publishes, so the BLS, when they publish CPI, how they're constructed, and apparently, pretty much since February. This is, of course, a little bit interesting timing. But since February, the portion that essentially is an estimate has gone up from 9% of the number to 35% of the CPI in June was based on estimates, which to me doesn't seem as objective, let's call it that, or could be less objective than a real numbers or a survey, whatever.
Yeah, people are going to perceive this to be political, and it's not a political comment. I want to be very clear. This happens in every banana republic in the nation, in the world. And China is well known for completely changing the numbers to benefit kind of how things look. So. And I'm not saying that Biden wasn't doing something similar with, and by the way, there's the last 4 years, there was a tremendous amount of, revisions happening on the employment side that were dramatic and consistent, that made all the employment numbers look great. And then, would fix the old ones after the fact. So, but I will say that those, kind of playing with numbers seem to be happening. And it's hard there's no way to know and no way to force the issue. But given the threats of firing Powell and the desires to have certain outcomes from the Fed, and given that the Fed is data dependent, and these are a lot of the data that they look at, it makes sense, right, that that an administration would want those numbers to look a certain way so they could get the outcome that they want. And where there's smoke, there's fire. The incentives are there, and then you start to see what's actually happening. Like you said, now, and by the way, historically, estimates were 10% or lower forever. This is like, if you go look at history, all of a sudden it's gone from to 30%. And why has it gone to 30%? Because Doge, or they've removed actually resources from the BLS. And said, well, you don't have enough resources. You'll just have to estimate. And then there's a whole, series of who's estimating and what's the, this is how you remove the true data away. You make it kind of a qualitative assessment, and then you put the people in charge that you want to be making that qualitative assessment. That makes sense. It sounds like a conspiracy. Listen, it's logical. I'd argue that if somebody was in power and wanted their outcome, these are the types of things that anybody would do. And then lastly, we go see the same thing in employment. I already mentioned that under Biden it was happening dramatically. You don't have to go any further than just compare private, the last private payrolls. ADP came and showed a dramatic, loss of jobs. Big surprise. Right. Everybody was like, holy cow. And then, non-farm payrolls, the government number came out and was like, nope, everything's hunky-dory. And it was a dramatic departure, one that we don't see that often. Not that it's never happened before, but it was dramatic. And then you go dig under the hood and see what's happening in non-farm payrolls. And it's like, where did all those divergences come from? Government jobs. It was massive. Yeah. Oddly, we just had a bunch of government jobs created this period. So, there's a lot of, again, where there's smoke, there's fire.
Sure.
But I think we're going to have to start taking the government numbers with a greater grain of salt, and start looking a little bit more at the private numbers, which is what we've been doing for a while now.
Speaking about smoke and fire, of course, this week, a lot of the headlines have been, and I think yesterday was another day where the potential firing of Jerome, or removal of Jerome Powell, was front and center. And what's interesting about this is that recently the focus has shifted a little bit towards something where you think this just isn't really relevant for how you said monetary policy, but apparently there are cost overruns on the construction or refurbishment of the Federal Reserve. And of course, the only way to remove him would be for quote unquote cause. Yep. And so it seems like the rhetoric is now shifting a little bit towards, or maybe we can use this overrun of cost as a cause because it's happening on his watch, and so on and so forth. Clearly, Trump wants an uber dovish Fed chair. He also wants someone who's a growth guy and a loyal guy to Trump. But it is interesting to see how the narrative is changing. And also, as you said, the reaction in the markets yesterday were pretty prompt.
Well, listen, so this is an important thing that not many people are talking about, actually. That everybody's talking about the Powell thing, but I think what they're not talking about is how maybe the best outcome for Trump is not to fire Powell, but just to make it believable that he could do it at any moment. Because if you think about it, listen, if he fires Powell, they're not going to be able to just lower interest rates the next day. First of all, that'll create some instability. And as we saw, by the way, when that first news came out that he had signed a letter to remove, that was the initial news, by the way. He was actually in Congress waving a letter, apparently, that said basically that he had signed, saying I'm going to fire. He didn't say this is the letter, but he's like, I'm going to fire Powell. I'm doing all this stuff, and that's what the market just did. What it did suddenly. And then he was meeting with the head of Bahrain immediately after, and they asked him, are you going to fire Powell? No, we can't fire Powell unless he committed fraud. So this is then, and the market rallied back. So, but the point here is that threat may be better than the actual reality, because the market perception that he could at any point now actually start lowering interest rates, become in charge of the Fed, is the psychology. and with hedge funds short and all the things, that is a real threat, and that allows him to support the market and to control kind of the narrative on the market side. The reality is, if he fired Powell, as we saw the initial decline, the 10-year will not like that. You talk about a steepener trade, you're going to see the front come down and the back go up. That is part of why this continues to go this way. That threat is a problem for him if he actually does anything about it. On top of that, it's not like firing Powell and putting dissent in will allow him to lower interest rates. There's a whole set of board governors that have to vote. And if he fires Powell, I'm guessing that's not going to make everybody at the Fed very happy. Right. So, he could have a Fed that is not cooperative if he fires Powell. So I think it's more about the threat. This is essentially like a shadow Fed move where you're moving in and you're projecting policy without actually doing anything. And I think that's essentially the game plan. I think that's what they're doing. I would be surprised if they actually fire him. I think it is a narrative to help support what he wants done. So, and I actually encourage people to think about, well, if they do want interest rates lowered ultimately, and they want it timing wise before the midterms so that the markets can be in a good spot by then, what needs to happen for them to get that outcome? How do they manage to get that outcome? I think, you probably need some weakness. You need some, and not some, and you need no inflation, right? And the only way to really do that, given the structural effects, is the tariffs and everything, is to see a slowdown, a cyclical slowdown. That's A, and B, you probably want kind of markets a little bit lower as well. So I think as much as they were projecting that, by the way, early, and that's part of why markets had a decline early on, and then they pivoted because it became a stressful event. I think a controlled demolition and an economic kind of slowdown might actually be what they want for right now, so they can then get their outcome early next year. So something to think about as well.
All right, now before we get to your outlook and crumbs, I want to take the opportunity of bouncing a few things I heard in a recent interview on Bloomberg. I think this was from June 11th, so that's about 6 days ago. And it was with the one and only Paul Tudor Jones. And I thought it was very interesting. I didn't, I just took a few notes, and I'm going to try and remember as much as possible and kind of fire at you. One of the things that came clear from his comments was that, first of all, in Trump's first period, he kind of normalized 4% deficits. That was kind of suddenly fine. Now he's kind of doing the same with 6 to 7% deficits. I think what Mr. Jones is saying is that at some point, the markets are going to cut, are going to force, whoever is in government at the time to basically stabilize the debt to GDP and try and really tackle the deficit issue. I think what he was saying also was that he felt when that time comes, this will mean lower bond prices, lower dollar, lower equities. Once the market accepts this reality, I think he said that the dollar probably will go lower just because of interest rates, short-term interest rates, of course, and which is also why he needs the uber dovish Fed chair at some point. And he basically also said that generally this idea of normalizing budget deficits at 6% or more, is generally going to be a drag on equity returns in the future, and that what we need to have will be negative real rates So say inflation 3.5%, but short-term interest rates, Fed funds down at 2.5%. That's what they should do. And then finally, and I'll let you then comment on all of this, he said, for him, kind of an ideal portfolio, although I don't agree with this view, but I'll let you comment first. He felt that on a vol-adjusted basis, gold, Bitcoin, and equities would be where he would invest, kind of thing. Although he did also say that his, I think, highest conviction, and again, I'm careful not putting words in his mouth, but I think his high conviction right now is actually the steepener trade, as you also mentioned.
Yeah, the steepener trade will continue to be the trade. It was an easy trade. It was inverted. Yields in the back curve were low. It is becoming a harder trade, but that does not mean it's not going to continue to work. Actually, I would argue the steepener could move even faster now, because before, and we talked about this, I think, a while back, before it was easy to hedge inflation. It was easy to make these hedges. So it wasn't, when a trade's easy, it's not going to move fast. But once it becomes hard to hedge inflation and it's already moved, now it's a hard decision for people to go out and deal with this long end of the curve. It's expensive. And so it's more likely to move now. But the price is not great, I will tell you, given relative to where we were.
Yeah.
So that's one. I completely agree with that. I've been hammering that for 3.5, 4 years. So I couldn't agree more. That's kind of at the core. I don't want to toot my horn too much, but we've been saying everything that Paul Tudor Jones is saying now for years, and that's good company. He's
sure.
I don't agree again with his. I agree with his view. His view is yes. What's inevitable at this point is the debt is growing at an unsustainable rate. The amount that it's devouring the budget. What's important and how I kind of am a little different on how I think about that is I actually am a believer that at least, and this sounds Pollyannish, but at least for the next several decades, at least probably more like 50 years, that the primacy of the U.S. dollar is not going away. And as long as the U.S. dollar is, and that's just because it's so entrenched, right? It doesn't mean it can't get degraded marginally over time, and that's happening. But as long as we're the reserve currency, the U.S.'s dollar is the reserve currency of the world, the debt can be monetized. And, you don't have to be the only reserve currency. By the way, look at what the Japanese did for 20 years. I mean, they monetized their debt. Yeah, debt to GDP is 260% or whatever, but less than 10%. I think it's 8% of that debt is external. And so they don't, their bank owns theirs. It's all internal. It's not really a real debt number. So the U.S. will do the same. If you think the U.S. is going to go into some austerity, and government officials are going to stop spending. I got some beachfront property to sell you in Arizona. That is not going to happen. And so again, we've talked about this for a long time. Spending will continue to increase. Budgets will continue to increase the debt, and it is unsustainable. All of this are things we know. What will happen is eventually the Fed will have to start monetizing the debt. I think that's inevitable. If you don't see that, and the Fed can. The difference is the Fed can. The question is, what will the rest of the world do when the Fed does that? And what will the effects be? And I think those are again, talk about convex trades, those are the things you should expect. And eventually it will come down the pipe and they will cause dramatic kind of issues. To the point that people don't talk about, when the Fed starts doing that, and essentially it's going to be a soft default, basically, they're better off doing it all at once. And I think they're going to try and be aggressive and get it out of the way, but they probably won't, because again, politically that'll be unpalatable. And so you're going to start seeing negative rates, and they'll probably they'll do it on the front end, but that'll cause a massive steepener, and then they'll do Project Twist, or like some type of try and switch it to long term. The the problem with that is if you keep long-term rates negative, short-term rates are one thing, but if you put long-term rates negative, you drive more inflation. You create an inflationary loop, and the short end can do that as well to some extent. We saw that again with Arthur Burns and some interest rates, et cetera. But the long end, getting manipulated down can be very, very bad for structural inflation because, listen, if I know I can borrow money at, let's say, 4% and inflation is 6% or whatever, what is everybody with any money going to do? They're going to borrow money and buy everything pinned down that they can, like any energy, any commodity, anything, any house, anything. They're going to buy everything. And if everybody's buying everything, that leads to inflation. And they're going to pull forward demand. They're going to borrow to pull forward, inventories and everything as well. And this is how you get into this, spiral. That's part of why, everybody thinks, oh, well, long in the curve's not a problem. The Fed has absolute control. They'll just lower the rate and everything will be fine. Well, yes, that will drive a spike in assets, but it also drives a spike in literally goods and all things, and that will then just drive a worse outcome. And again, this is what we saw in the 70s. This is what we saw, and this is a worse situation because they got to do even more of it to control the debt issue. Back then, we didn't have a real debt issue. So yeah, like inflation. Inflation is may seem subdued now. It hasn't gone away for a while. We've talked about why it was not going away for good. You can kind of normalize at a higher level a little bit here, but that will come to a head, and I think it's way sooner than people think too. I think it's in the next 5 to 10 years we're going to have a serious issue there.
Yeah, no, absolutely. And also maybe, and I'm thinking, where did we hear this first, or who did we talk to about this first? And I'm not sure. Could have been Peter Atwater, actually, but there's this American wrestling term, KFAB, or something. I'm not even sure what it is, but it's this idea that what you're watching isn't real, but we're still watching it. And then until it, since I'm Danish, we would just say, well, it's like the Emperor's, clothes, the fairy tale where, he didn't have any clothes, but everybody, talked about it until the little girl says, well, there's no clothes there, so there's no dress. So it's that moment, in a sense, that I think more and more people are just waiting for to happen, which is a weird thing to say, but that's just how human behavior is. We don't want to face it until, a little bit like the Biden moment.
Yeah.
Remember, that debate where suddenly everybody could see it. You couldn't unsee it, right? In a sense.
Correct. Yeah. And I think the place you're starting to see it are the 30-year bonds, particularly in Japan, because the reality is markets, in terms of short-dated markets, can be manipulated, not manipulated, but more control. Buyers and sellers it can match, and if there's an understanding it's going to happen, it's less likely to happen there. But the illiquidity at the back end of the curve and the finality of once you go far enough out, right, of that outcome is really starting to show its stripes at the very,
and
very long
another
end
bond that's interesting. I do agree with the 30-year in Japan, but also the 30-year in Germany hits its highest level in 14 years this week, I think.
Correct.
So you're right, absolutely.
Yeah. The one thing I wanted to touch on, I didn't get to with Paul Tudor Jones, is his asset allocation, which you mentioned.
Yes. Let's talk about that.
Yeah. So gold, Bitcoin, am I bullish on those assets? We already talked about that. Yes, I am, and I have been in this structural period. But on a risk-adjusted basis, again, I already mentioned how volatile gold can be, and we all know how volatile Bitcoin can be. And if you're going to be that concentrated, and by the way, you can lose 50, 75% in both those assets in a matter of months, a year. And in fairness, he did say and stress vol adjusted, just so people didn't think he would want to buy equal amounts. Yeah. But it's still 20%.
Sure.
Right? These are big allocations. or I think he said a third, right? A third. Like
no, I don't. No. He just mentioned those 3 assets. He didn't put a percentage.
I think he did actually. Well, at least maybe it was like the time before he mentioned that. Okay. But he's been very, very like oversized on those things. And then he says the third one is equities. I cannot agree less with the equities comment. Any asset that is not a kind of a store of wealth like gold and Bitcoin have. And we've talked about this in the structurally inflationary periods we see performs incredibly poorly. It is a awful risk reward. And 68 to 82, we talked about this, right? The S&P 500 during that 14-year period, that inflationary period lost, about 50% or so of its value in real terms. And that's 14 years of holding on to a volatile asset and then getting paid off, with negative half your money. I have people think equities are a hedge for inflation. They're not a hedge for inflation. I want to be clear. And people who are scratching their heads at that, it's because of the discount rate. Stupid. Like the reality is, 1968, we had call it a 5%, 4.5% yield on the 10-year. Guess what the earnings yield of the S&P 500 was? About 4.5, right? It was at 22, 23 PE, which is similar, 4.25, right? Similar to now, very similar dynamic. 1982, and again, we've talked about this. 20% yield in the 10-year bond. Guess what? 4.5 PE, which is like a 22% yield. Those two things are integrally connected, because if you can go and get a 20-year bond or 10-year bond for 20%, why the hell would you ever buy the S&P for anything less? And it may not on an annual basis or a monthly basis or quarterly basis be in line, but you better believe on a multi-year basis, those things are going to hold true. And so, yeah, if we're getting a steepener and the long end of the curve is going higher, like he's saying, I don't understand why you want to own equities or any yielding asset writ large. It doesn't mean own no equities. It doesn't mean like no kind of equities. There are some equities that you got to be very tactical that will expand profit margins, right, into increasing interest rates, and that's a small subset, about 20 to 25% of the S&P 500. Those are the businesses that actually can counteract the multiple contraction. They will also be subject to multiple contraction, but there are companies that do very well. The problem is equities writ large not only get hit by the discount rate, which is the most important thing, but most of them have their profit margins contract. And we were talking about how we think we're going to start seeing that here in earnings coming soon. But that is the big problem. If you can find the equities, which we can talk about those on another show or another time, which I have a whole list of, and we do that for our clients. You want to be focused on the companies that have negative working capital and are have improving outcomes on the equity side. But again, you got to definitely reduce the equity exposure that you do have, if any, as a result. So there are way better non-correlated. Our approach would be more non-correlated, investments, and these are actually not assets.
Right.
I think he just talks about assets. We think 30 to 50% of a portfolio should be non-correlated, and there's. We can do that now. This is not 1980s investing. This is 1960s investing. And I think Paul Tudor Jones, much like a lot of other people, the majority of people only thinks investing is buying assets. And I think that's part of the problem there.
Yeah. The good thing is I'm hopeful about Paul Tudor Jones simply because not only is he very successful, also he started out as a trend follower, which obviously he goes very high in my book. But there was another reason why I just thought when I heard it, I thought, interesting allocation, because I thought, well, if you're really worried about high interest rates, is gold really going to help you with that? Or is Bitcoin in a high interest rate environment really going to skyrocket? It could go up for other reasons, of course. I mean, if the whole thing blows up, maybe gold and Bitcoin will do well. And under the current administration, where there's a lot of support for these crypto assets, of course. But anyways, I do want to get to one other point because you mentioned it briefly, and it was actually also something that Mr. Jones touched on before we wrap up today. And it was actually AI. He had a whole section about AI, pretty scary actually. Obviously, he gets invited to conferences and to talk to people that we don't, for sure. but maybe this was actually public news that he was quoting. He was quoting the following. One, he said that Elon Musk is saying that there's a 20% chance of AI wiping out humanity. I thought that was a big number. The other thing he said, that the head of Anthropic, Dario Amodei, who's the CEO and founder of that company, is saying that he could see 10 to 20% unemployment in 1 to 5 years due to AI, which is white-collar jobs specifically. And also, the big, beautiful bill has a moratorium on AI regulation, was mentioned, which means no safeguards. I mean, we can really go anywhere, it sounds like. So those were very interesting things.
Yeah, the one that I was kind of insinuating, and with let's dive into it, is unemployment.
Yeah.
What happens when, again, I do think those 10 to 20% numbers in the next 1 to 5 years are not like that. That's likely. And that's, let that sink in. Like,
yeah,
that is a big deal. The unemployment rate for college graduates this last year is at 9% in the United States.
Wow.
It is 4%, give or take, for the total public. And by the way, just a year ago, I think that unemployment rate for college graduates was like 6.5. And the year before that, it was more or less in line. It does tend to be a leading indicator of unemployment increases, by the way, because companies first stop hiring before they start firing. But it's even more dramatic than we see in history. And if you dive under the numbers and you look at, and we don't know for sure that AI is the cause here, right? But, and there's other things going on, as we talked about. But if you dive under the hood and see where the unemployment number is the highest, computer science graduates, electrical engineers, people who are programmers are completely not getting hired. Yeah. And it's a lot, almost every category that's high is one that is being, quickly replaced by AI. And so I can tell you anecdotally, I mean, I've hired a lot of people in the last year. And when I have, we thought that we would need to hire more, more recently. And those hires are now doing the work of 3 hires, 4 hires, each. And so it's happening, and it's happening way quicker than I expected. This is like, I'll do a mea culpa here. I thought this would be, a 1, 2, 3 year kind of forward dynamic. It is happening fast, and the effects are we have to start seriously talking and thinking about those effects on a much quicker timeline. But yeah, I do think, and again, as I mentioned earlier, what we need to start thinking about are the political ramifications of that. And again, it's not, particularly if those hires, the lack of hiring in the younger generation is going to be the main primary issue. That is going to lead to a lot of already frustrated, angry, young kids stuck in mom and dad's basement. Like, we have these millennials on down we've been talking about who've been driving this populist rhetoric. If that populist rhetoric is only going to increase due to AI, which is not the core driver, it was already unequal, right? Populism is not only not going away, it could be hyperdrive right as baby boomers are, who are the more capitalist kind of side of things are starting to pass on. It creates a very, very volatile political environment. And if it were happening in a non-populist cycle, like let's say AI started to thrive in a period when, it was 1982. Okay, well, free market economics, we have a more equal society already, and we're already going to supply side economics. You can manage that potentially. This seems like a very, volatile situation, and never mind the lack of regulation, the size of the corporations that are running this, so the centralization of power that we also talked about already. Those things combined create a very us versus them environment. and we are already in us versus them, it is only going to create a more unequal and concerned youth. And so, yeah, UBI is coming, by the way. Like, I'll tell you that right now, and we can point back to this. I've talked about it for a while, but this is like, it's become increasingly clear that we are going to have to go to and again, how do you deal with that in terms of a budget? Like, if you're just, you're going to have to redistribute money to people on the bottom. And that is going to continue and you're going to have to do more protectionism to protect your people against the other people to try and, like, this is the whole cycle, and it's only getting accelerated, I think, by AI. So I would watch that very closely. I think in 3.5 years, when we're at never mind, a year and a half, it'll start to be an issue. But by the next election, that creates a very volatile situation. And I mean, it's going to be populism versus populism. Like, how do we and fiscal spending, look for fiscal spending to dramatically increase again as we go forward.
It ties so well into our conversations, which I'm not going to recap here, about the fourth turning, and we still have a few years left of that. But one thing that really took me also by surprise, and then I'll move on to your crumbs, which people are probably dying to hear. He also said very specifically that in the last year or two, it's come to the realization that libertarianism is as big a threat to the US as socialism. And I thought that was a very interesting comment, that you simply can't let people just do whatever they want with no safeguards. And obviously that may have come more to the forefront given what's happening now with AI. But that was, I was surprised to hear that.
Yeah, I think that's been the case. It's actually, again, don't want this to come across as in any way political, but the reality is, this last bill actually does the opposite of what the populace wanted. The spending is still there, but it's actually now the tariffs are doing what the populace wants. So it's kind of a balance, and I think that's part of why they had to do the bill the way they did, to try and balance some of the effects of tariffs. But the Doge piece, right? And by the way, I think this is part of why Elon's kind of got pushed out the door, which we talked about, which most people didn't believe that was actually, when we were talking about it last, that there was a conflict and there was a divide. Yeah. Clear now, but I think really important to note that the Doge movement of really hollowing out regulatory authority is going to give more power to wealthy corporations, to and that's the main focus. It's being sold as like, oh, there's all this fraud or all this we're cleaning house, but the reality is what it's done, as we're seeing with the BLS we just talked about, right, is a ability to control and not give for the people with money to go more unchecked. And that's why they're hollowing out the IRS in particular, and all kinds of other laws like that. So I think the AI deregulation that comes in the bill is another example of that. And I mean, if you're not going to give people what they want, and you're going to kind of continue down the path, which is, the path that things go to, absolute power corrupts absolutely. At some point, the angry hordes will come for you. The question is, are our AI overlords going to be able to control that? And I know that sounds, but that's where this is heading. And we've been talking about it for a while, and every year we're going further and further down that path. So yeah, fourth turning, we're walking directly into that path. We should have been recording this 3 days ago, Jim, when we talk about these things, because it was Bastille Day in France. And of course, we know what happened back then. Exactly. Anyways, before we get too excited about that, one thing that people will be excited about is always to hear, kind of without this being in any shape or form investment advice, but you have volunteered some interesting calls over the years.
And I'd love to hear where your thoughts are right now in terms of where you think markets are heading. And maybe I can add to that because that is part of that second question we got early on, was maybe also some of the reasoning for why you think markets might go to where you think they will go.
Yeah. So Summer of George, we already talked about, right? Placidity, driven by a dramatic vol. Supply that's structural, which is based on structural product issuance and low volume and that compression. That leads to supportive charm flows, which support the market, and reflexively also leads to lower realized volatility. That's what we've seen again, and that shouldn't be a surprise. It looks a lot like last summer, and the summer before, honestly. The added part, as we mentioned, is the hedge fund positioning, which is creating that dispersion. And so we're in a full-on pain trade at this point. It's been several months of that. And again, the dispersion that comes from index compression is driving more pain, particularly underneath the market. This year, as I mentioned, institutions are also cut short, so it's even worse. And it's driving a continued kind of tick, 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 tick in the market. That short positioning by institutions, until it's resolved, right? This market can't go down in a meaningful way. So the when we do get a decline that will, or sideways action, that deleveraging is important, because as that deleveraging happens, then it allows the fuel comes off the table for the up move, and the decline will have less demand underneath it from institutions. So we're watching the the short positioning come down. That's critical. It's being forced upon institutions. And so as that's happening, we're also starting to see sentiment percolating to kind of record levels. So this is a process. We think that, that short positioning, which, by the way, happens for a reason. There's a lot of reasons to not be, from a macro perspective. I don't think I have to point too far in too many directions to show you all the risks and the issues. We talked ad nauseum here today about a lot of them. The reality is that until positioning gets back on sides, that it's hard for markets to go down. Doesn't mean the weighing machine won't take over. The weighing machine will take over. This is a very important point. So let's go directly to kind of timing and issues. The end of the year is a bit of a magnifier to whatever's happening going into the end of the year. So as we get to October or November, early November, if markets are still up, right, the end of the year, we'll see more vol compression, a little bit more of the summer type action, with an accelerated kind of rebalancing, releveraging effect that comes at the end of the year. So if this market does not start a decline in the next month and a half or so, and it doesn't need to be, actually the best outcome is a slow boil the frog kind of, heat up the water without any vol. And again, I don't expect anything like last year at all. So people automatically think, a decline's coming, we got to get short long puts like the vol. No, I want to be clear. And if, by the way, that happens, that's not good for a bigger decline to actually play out for several reasons I can get into. But the most likely outcome is whether this is soon here, because we're now getting to expiration tomorrow, or August cycle, some type of small down would be most likely. And if it happens, which is hard, by the way, and we won't, because you have these, if vol is compressed, it's going to be very hard for the market to go down. But that would be ideal as well, because it'll allow, and again, it'll be muted because all these short interest from hedge funds and whatnot will have to be bought back. But all the internals are showing that there is underlying weakness and that the bond and term flows that kind of run into this expiration are likely, as they go away, to lead to allow markets to kind of, these jaws to kind of come back in line, these divergences. So if we see that, which we think is likely, it's likely to be a small 1 month decline. I think 2.5% to 5%, like a nothing burger, really, given how much we rallied. The interesting part comes a month from then, starting in August expiration, like as I mentioned, because of the SEP OPEX. And under the hood, if you look at skew in the S&P and a couple of other places, there is a big dislocation between August skew and September skew. And that's kind of a clue that there's a lot of pain sitting out there in that quarterly potential pain, right? As we know, these quarterly option expirations are always an issue, but there's a breakdown there. And so that could activate, a grind lower with vol compression, calendar expansion, skew continuing to stay high in the back, but the puts in the front just disappear. Could force a chase that could even make that worse. It could build on itself and then eventually lead to a bigger decline in August to SEP. Now, I don't think that August to SEP decline either will be a big one, but it could force more of that action. And instead of a 2.5% to 5% decline in a month, you could go to a 5 to 7.5% decline the next month. And then you start looking back, you're like, wow, this is a 10 to 15% decline. And by the way, that would take us right back to 5,700, where we were at the beginning in May, not that long ago. And so that would make a ton of sense. And I think that's probably the most likely outcome: market down, vol down, calendar expansion. And I think in that process, the pain will probably still continue momentum versus value until about, late August or so. And then you'll probably see a bit of a turn in that factor as vol finally releases, probably towards the end of that move a little bit. And it won't be a big increase in vol, but like some type of taking it from completely pinned to the floor, right, out a bit. And as that happens, I think you're probably going to get some type of relief rally from 10 to 15%, probably around SEP OPEX after some resolution there. And if that happens, if this all plays out, right, as I'm saying here, the big question will be, how does that relief resolve? And that's still, we will have to see. That'll depend on some of these macro outcomes, and we're going to get a lot of data between now and SEP OPEX, and a lot of very important data. The next 2 months are basically, all the things we've been waiting for are coming now. It's earnings, it's inflation, it's employment, and all the things. And never mind, we'll see how this Powell, Trump stuff resolves, and what their reaction is. And I'm guessing if the market does decline there, they're going to try and kind of support it along the way as well, which will also help create compression. Again, controlled demolition, which I think they probably wouldn't mind. So all these things kind of point to that kind of an outcome. Now the question is, let's say SEP into October, or first couple weeks of September, we get a bit of a rally back. And we'll have to see, by the way, how does institutional positioning look? How does how's retail positioning look? How's sentiment at that point? But I have a feeling that retail has had such a positive experience here. I think 2021, that once 2022 comes, which again, I feel like this is more of a 2022 type decline.
It sounds like it, for sure, yeah.
They're more likely, this is why the boiling the pot is effective for a decline, is because if hedges don't work for institutions, that's painful, and that makes it worse. If you don't get a vol expansion, you can't get a V bottom because all the vol. And then also retail, who's been the primary entity supporting things, will continue to try and buy all the way down. If there's a big vol event, they get kind of pushed out. But if it's not scary and they keep hoping, then, and that's what happened in 22. You can get a real kind of just painful grind blower. I could see that being a like that. So if we can't get the resolution in October, some type of momentum, and then it starts to roll back over, that's when it could get interesting, because again, the end of the year is this very kind of magnifier, and usually the end of the year is positive, and people know because the markets tend to be up. And even if it's neutral, it's positive because again, 5% interest, companies make money, they reinvest. But if we're down 10, 15% come October, and then we start to roll over, then you can get a magnifier into the end of the year. And we saw this in 18, Octave Dies. We had this 20% decline in 2018, right? Which was, again, people were kind of scratching their head, but that's how it can play out. So I don't want to say we're getting, but this is how it would play out. I will say as a caveat that if it does not happen in the next month and a half and really get some of this weakness, and again, ideally a boiling of the pot type weakness, like a nothing burger to most people, like a 2.5% decline would be nothing. But unless we start to see that, or if we, or if we start to see a rally that continues to next month, it's going to get really hard into the end of the year to get a decline in that case. Sure. And actually in that case, you start to see more of a 98 kind of blow off top scenario coming, because then there's this, I kind of describe it as a dance. The pattern, the beat matters, where and when the steps happen, because then you have a midterm coming next year, and then you have them taking on the Fed chairmanship in June, right, next year. So unless we start getting a decline now, like soon, and again, nothing big, nothing like the price action now really matters. And it's not, and again, I don't want to put too much weight on it, but like the next month and a half, 2 months is kind of critical. And again, if we don't get the decline, then there's all the supportive flows in the end of the year. And then we start getting into early next year. You're running out of time. It's a midterm. They want a positive outcome. They're also going to try and bring monetary stimulus in and get things moving again. And then you see a year and change of a continuation here, which would be a squeeze in a situation where institutions are short, and this thing could just kind of really blow off. It will resolve poorly directly after the midterms, in my opinion, if that's the case. And again, the dance steps will be, they would prefer for that to happen as soon as the midterms are done, so then they have time to resolve it and come to the rescue by the end of the year, or if they're unable to, create a bigger crisis that then they can use to accomplish their outcomes. But these are the kind of the two scenarios, and we're at a pivotal point here to take advantage of it. But I will say, knowing that those are your most likely paths itself is incredibly valuable, because you can bet on both paths at the same time.
Well, first of all, thanks so much for that, for sharing that. I know our audience love hearing these thoughts. Not a lot of people are brave enough to venture into that. But a couple of things. First of all, the best way to make sure that you see how Cem, continues to evolve his views is, of course, to always tune in, to the podcast, of course. But also, I have a suggestion for you, Cem, because you have such a strong and large social media following, and that is, you should record yourself with doing 2 different dances, because you love memes. And then you can just play the dance that you think we're in, and then if you change your mind, you just play the other meme.
Yeah. No, I try and be subtle, but yeah, that does.
It's
people
just
have to tune into these conversations to get the clarity.
Okay, maybe we'll leave it at that.
But I'm with you. I'm all about more memes, more memes on social media. Maybe I'll record a dance.
Sure. Well, first of all, amazing conversation. I really appreciate that. We had not a lot of things planned, as I said in the beginning, but we have in fact probably recorded our longest edition of our systematic investor conversation. So I hope that everyone listening will appreciate everything that goes into Cem coming on and doing these incredibly detailed conversations. And if so, please go and leave a rating and review on your favorite podcast platform to say a big thanks to all of the efforts that goes in from his side. Next week, I'm back with Andrew and Tom. So that'll be an interesting, fun conversation. We're going to dig into a new paper that's come out, and actually a special edition of that paper we got from the source directly. So tune in for that. Make sure you watch all the 4 episodes of You Got Options with Cem directly from the SIBO floor. They're incredible conversations. And of course, not least, from Cem and me, thanks ever so much for listening today. We look forward to being back with you next week. And until next time, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.